All right, so consumer confidence has dropped quite significantly here lately, and we have a really good question of the week actually from Blain. So thanks for sending this in, asking essentially what is the impact of lower rates on investments moving forward. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue, and our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a bit of the noise along the way. And quite honestly, this week is going to be a little bit shorter on the data front. There has been a lot of Fed speak over the last, 7 days or so. But outside of that, there hasn't been a lot of real critical data to highlight. Obviously, there still has been. But one of the things that I do want to highlight is consumer confidence came out earlier this week. And the reason I wanted to highlight it is that this was much lower than expected and much lower than the last read as well. So these consumer confidence numbers, to be clear, they can bounce around quite a bit. So don't read into this too far. One data point is not, the end of the world, but certainly worth noting that potentially consumers are getting a little bit more concerned, maybe a result of the elections, maybe a result of the Fed. There's obviously a number of reasons that might be leading towards that. Secondly, is jobless claims came out today. So the jobless claims were below expectations here again as well, which I think is important to highlight. And then the GDP revision came out as well today. Basically, it's the same as before and right in line with expectations. So nothing to really write home about, but I did want to make sure to touch on those data points. All right, so before I get to the question of the week, which I'm going to spend a little more time on given the shorter data side of it this week, be sure to tune in next Thursday because we do get the inflation read tomorrow, which will be very timely, obviously, after the Fed conversation there last week, as well as income and spending and all of that kind of ahead of jobs week. So we will have a lot to cover the next couple of weeks here. Be sure to tune in. But before we break for this week, again, thank you, Blaine, for reaching out with this question. The question is, what is the impact of lower rates on investments moving forward? And I want to try and tie this to 4 different asset classes. I'm going to look at equities, bonds, commodities, and cash in general. And keep in mind as I go through this is going to be very conceptual, very general, but nonetheless, I do want to talk about how this can impact each of them. So first, let's talk a little about equities. So in general, lower rates can be a good thing for equities, and there's a couple of reasons for that. Number one is if rates are lower, it means that companies can borrow for cheaper. They have more options to find capital, to invest, to do the things they need to do to grow the business. But secondly, is also as an investor, think about it this way. If you have 2 options, you've got bonds and equities or stocks, and let's say bonds are paying a lower rate of return, you might be willing to pay more price for your equities, given that you're not getting as much on the bond side of it, right? There's a risk reward trade-off that starts to happen when rates come down. Now, to be very clear, as I share all of this, one rate hike or rate cut, excuse me, does not completely change the script here. It's just kind of general concepts as rates may become lower. But if you look at an extreme example, that can play a role. Now, that said, keep in mind that rates may be getting cut for a reason. And so although generally equities might do well when rates are lower, the question is what happens in the short run? Are there cracks in the economy? What does that look like? And that, will remain to be seen. Second is bonds. So you've heard me talk a lot about this over the years in terms of how interest rates impact bond prices, and they have what's called an inverse relationship. So if interest rates rise, bond prices actually fall. So, during this period when we were hiking rates, we saw a lot of impact to the bond market. In fact, you might remember in 2022, some of your bond portfolio might have been down as much as your stock portfolio. Now, a way to handle that is to kind of shorten the length of your bonds. It kind of takes out some of the volatility, maybe a separate conversation. But the opposite applies when rates come down. So as rates decrease, bond prices actually increase, right? If you are locked in at a 5% rate and now bonds are only paying 4%, your bond might be worth more than the same 4% machine you could get brand new, right? So again, as interest rates rise, bond prices generally, as interest rates drop, bond prices generally appreciate, generally. Third is, and actually let me highlight the generally part of that. So the reason I want to highlight that is that the Fed does not directly control the rate on bonds, right? The bond market is going to be a little bit more market driven. in anticipation of what the Fed may do or how rates may transpire in the future, which is why we see things like inverted yield curves and all the like. So take that with a bit of a grain of salt, but the concept still applies. Third is commodities. What I will highlight here is that when I want to highlight the impact on inflation more than anything else. So if inflation picks up, generally commodities can tend to do well in that type of environment. And the reason I'm highlighting that is that with rates coming back down, if we happen to see money supply and possibly therefore inflation either remain elevated or pick back up, that's something to keep an eye on as well. And then last, I will highlight cash investments. And really, let's talk about cash in terms of CDs, money markets, high yield savings, that kind of thing. And what I will share is that in general, as you might imagine, those rates are likely to come down. Those rates are really driven off of very short-term interest rate movements. And so when we see the Fed pull back rates, it's very likely that there might be a bit of a slight delay depending on the type of cash instrument you're looking at. But generally, those rates will start to follow suit as well. And not dramatically, right? Again, this is one rate cut, so it doesn't mean they're all going to drop tomorrow. But in general, instruments like CDs, for instance, the bank kind of dictates they might have priced that in already. Something like a money market account generally is going to be based on very short-term bonds. And so that might follow suit here shortly. In fact, we're starting to see money markets kind of pull back slightly. It's still a good, good risk-free yield. And keep in mind, obviously, there's risk in everything, but when we look at cash equivalents, it does provide still a good yield in the general scheme of things. So hopefully that's helpful, Blaine. I appreciate you sending this in, and I did want to unpack this quite a bit since we had shorter weekend data. But be sure to tune in next week because we'll be covering, again, the inflation read tomorrow, income and spending, and again, all of that kind of wrapped into a jobs week as well. In the meantime, have a great weekend, and we will see you next Thursday at 3.